Welcome back to the Secret Stash podcast. My name is Chuck Charlton from the Charlton Advantage team. I'm here in the beautiful office of the LA Mortgage team, and I'm here with Ana Cruz. Welcome.
Thank you.
Yeah, and we're going to talk today about mortgages. Hopefully make it fun, because we've talked about how mortgages are not really the most fun, sexy topic.
Not
but
really.
They have a huge effect on your enjoyment in your life. It's obviously a large part of most people's commitment on a monthly basis financially. So let's dive right in and start talking about affordability. And one of the things that I really appreciate about a good mortgage consultant is that they see things, not just like, what's your rate? As I call that like the order taker. Somebody says, I want the lowest rate. Okay, fine, I'll give it to you. I think there's a bigger conversation that needs to be had. So can you explain your process of how you would actually coach somebody through what the right amount of mortgage is?
Well, it all comes down to understanding your affordability. So when you walk in the door, when anyone walks in the door, my first question usually is, what is your budget? What do you think you can afford each month? So if your budget is, $2,000 a month or $1,500 a month, we can kind of start with that. And then we're going to be looking at your application to see, okay, so are we within that?
Right. And you're going to look at the other stuff too, because I would guess that somebody just plucking a number out of the air, it's not always accurate.
No, it's not.
Right.
So, but that kind of gives us our ceiling. So what we do now is we look at the application, we take a look at everything and say, okay, so now your budget was, $1,500. We actually are below or above that, and how do we work with that? Making sure that you're not cash house poor. That's important.
Right.
And always making sure that, okay, so have we taken into account condo fees? Have we taken into account property taxes? So there's a lot more that goes into it than just the rate. It's about what's your affordability each month.
Yeah, and even life can change. Yeah. We talked about in another podcast with Annette about how a lot of people, when they get into a home, first-time buyers, is they have a baby. That's kind of a common thing. So your mortgage company is not looking at, are you going to be on mat leave or anything like that.
They don't look at your Starbucks coffees or your Tim Hortons coffees or your 407 bills. Like there's so much that needs to be taken into account. So it's more than just a rate. It's more than a number. It's let's see what fits into your life.
Right. And the bank has I will call it like checks and balances that exist so that you don't overextend yourself. Yeah. But that's only good to a point. So looking at your actual specific situation is very important. And that whole conversation around rate is very interesting because it is important. It obviously has an effect on your payments, but it's not the only thing.
It's not the driving. It really isn't. It comes down to, I've had clients who are absolutely in love with the house, and depending on the lender and what options that lender gives, they may choose one lender over the other, even though one is, $5-10 a month more expensive.
And why would they do that?
Well, you're looking at options. So you're looking at, a lot of people also look at prepayment options. So we haven't talked about that too much, but prepayment options are how much are you able to pay towards the mortgage each month to pay it off faster with no penalty, right? And so that's important because there are lenders out there who allow you to do increase your payments by 20% of your monthly amount, or you can do lump sum payments of up to 20%.
Right, every year you can throw a bunch extra in. And my favorite example is, you could pay off a 25-year mortgage in less than 7 years if you doubled your payments. Because anything above the minimum payment or your sort of normal payment is all principal. So you're carving, the meat right off the back end. There's no filler, no fat. It's just you're taking years off the back end. You are very efficiently.
It does really. I mean, if you're doing those extra payments, you're right. It's going all to principal. So if you can do those, even if you can't wait for a lump sum, even increasing your payment slightly is going to pay off years faster.
And you have the option of doing that. Some of the mortgages out there are very restrictive in a sense that there's big penalties or they won't allow you to, because people do break mortgages. They commit to 5 years and job change happens or any of those life circumstances.
Well, you bring up a great point because life does happen, and it's not always about getting into the mortgage and what is the 5-year rate, what can I get into. It's about the rate, it's about the affordability, but it's also about getting out of the mortgage.
Right.
So many people don't focus on getting out of a mortgage. It's like no one walks into a contract or a relationship thinking of the end, but the reality is you have to look at the full picture.
Yeah, you really do.
Yeah.
And okay, so fixed and variable is a big decision that people have. What are your recommendations around that?
Well, I think when it comes to fixed versus variable, it's a very personal. Everyone has a different opinion on it. I personally like the variable, but it has to suit your lifestyle. It has to suit your budget. But I always say, I get this question every day. If you are a variable person, you're not going to get up every morning thinking, what are the interest rates today? Have they gone up? What's happening in the news? What's affecting my interest rate?
I've seen that before.
Yeah.
And I've actually said to a client, I've said, look, you're saving $50 a month, but you're going to need to medicate yourself. So you're reinvesting your savings into sedatives, right? Because it's just such a, so you need to be able to weather a storm. I know for me, is being self-employed, having some fluctuation in income, in addition to having, some savings set aside, is I want my payments to be the same. And that's what we call a fixed mortgage, where, there's no changes in payments, interest rates, everything else.
Yeah, and the variable mortgage, for just to go back a little bit, that's where the payments do fluctuate. For anyone who hasn't really gone through the variable fixed discussion, the variable, as prime rate increases or decreases, your rate's going to increase or decrease. So normally on a variable rate mortgage, you're going to have prime minus a percentage. So let's say it's prime minus 0.5. Then if prime goes up, you're always going to be minus 0.5, but it fluctuates, and you just have to be prepared for it.
Now you use the example, is it $10 per 100,000 for every quarter point increase?
That's exactly it. Yeah.
Okay, perfect.
Yeah, so, and that's a good way to look at it. So if you've got a $200,000 mortgage, for every time the Bank of Canada goes up 0.25%, it's going to be about $20.50 that it's going to cost you. And I think if you're going to go into a variable mortgage and you're open to weathering through the ups and downs of it, you will always pay off your mortgage faster. But what you also got to look at is, if you can increase those payments already slightly, then you're not going to actually feel those increases, because you've already protected yourself against any increase coming up. And so I find that I have a lot of clients coming in right now saying, I'll take the variable, I'll increase my payments by $100 a month, and then if the rate goes up, I'm not going to feel it.
Interesting.
Right? So it's a great strategy.
Yeah. And there's really, historically speaking, the variable has always performed better than a fixed when you look at paying less interest over a longer term, over 5 years or 10 years. It always seems to be the better option.
So I regret not having it.
Right. And I feel bad not having a fixed, but I also feel much more comfortable at night knowing this is what my mortgage payment is.
That's exactly what it is. Yeah. And I was that person. I've had a fixed forever, and then I got into this industry years ago, and I'm like, okay, I think I can do this.
Right.
Let's do the variable. But it does take, you have to be ready for
That's
it.
a bit of a leap of faith.
It is.
So that's by one decision, and is that you could potentially save yourself, even over the next 5 years, you could save yourself, $5,000, $10,000, $15,000. And there's the whole risk reward, right? But historically speaking, the variable is, more favorable for the total interest payment. There's less. So can we talk about some other ways that you can, just by a simple decision, that you could potentially pay off your mortgage a lot sooner? There's terms. This is misunderstood, I think, even by a lot of real estate agents. Terms like biweekly, accelerated, but I mean biweekly. Obviously, it's not that complicated, but they're kind of they're blended together, and there's ways that you can use your payment frequency to actually save yourself some money.
So I think the first thing is to explain the monthly is pretty straightforward. Monthly is monthly, so whatever your mortgage payment is, that's what you're going to pay each month.
Right, on the whatever day of the month.
Yeah.
Right.
So if you're paying on the first day of the month and you're paying $1,000, that's what you're paying on the first of every month. The bi-weekly payment, because there's bi-weekly and then there's accelerated bi-weekly. And this is, I think, where everybody gets confused, trying to understand, why do I want accelerated versus regular bi-weekly? Right. I'm already paying it more, and I'm already paying it faster.
So bi-weekly is 26 payments. Now, the total for the bi-weekly would end up being the same as the monthly at the end of the year, at the end of 12 months?
You're still going to get an extra 2 payments in there, right? Because
Okay.
you're doing 26 payments instead of 24. If you were to take a month and divide it by 2, you're going to get 24.
Okay.
If you're going to take bi-weekly, you're going to get 26 payments in there. So you get an extra 2 payments that you're paying it off faster.
Okay. And that's what the regular
That's
bi-weekly?
regular bi-weekly.
Okay.
So you got 26 payments.
Yeah.
So you basically take the monthly payment, divide it into 26, and that's your number.
Okay. So 13 months and 12 essentially is what you're doing, right? Split up.
No, that's bi-weekly.
Okay, so that's, but you do end up paying a bit more, right?
You do pay it off faster, so what you're alluding to is now accelerated bi-weekly.
Okay.
So accelerated bi-weekly, this is the big confusion I think out there, right?
Right.
And you know what, I wrote it down all, because I get this question all the time, so it's just something I end up sending everybody.
Yeah.
But the accelerated bi-weekly, which is I think where everybody gets sort of confused. The accelerated bi-weekly is where you're going to take that monthly payment, but you're actually going to add another monthly payment. So you're adding 13 months of payments instead of 12.
Okay.
So now you've got 13 months of payments in 1 year, and you're going to divide that back into 26 because you're going to do 26 payments, which are bi-weekly.
Oh,
and so now
okay.
That's where you're kind of like, think of it as you have a baker's dozen mortgage, right? You've got 13 months that you're paying off instead of 12 over a year, and they're accelerating it. That's what they mean by accelerating it.
And the impact of that can be huge.
Huge. If you go to accelerated bi-weekly, usually you're paying, it depends on your mortgage amount, of course, but 2 to 3 years faster. So if you were to take a 25-year mortgage, when you come up for renewal, you're normally at 20 years. You've had a 5-year mortgage. If you do accelerated, you're probably going to be about 17 and a half years.
Wow.
So without really doing any effort at all, but just starting with accelerated bi-weekly on the first payment, and I do suggest starting on the first payment, because once you've had a taste of a lower payment, you're not going to want to do the higher.
Right.
So start it off with the accelerated bi-weekly and pay that off a little faster.
So 17 years, an extra mortgage payment,
Yeah.
$1,500, let's say. You might invest, $40,000 in that amount of time or whatever it is, but you might save $100,000 or $150,000 in interest.
Absolutely.
So
It's
that's
definitely
pretty
worth
amazing.
it. I mean, it's just one of those things where you got to just sit down and work through it.
Right.
And I just don't think there's enough understanding about the payment frequencies and how they really can impact.
Right. It's kind of that order taker mentality. I want the lowest rate and I want it monthly. Well, have you thought about this? Have you thought about that? What if this? And that's where a really good mortgage consultant can help sort those kind of things out. Okay, so we can do another call. And then we'll just fix. You want to just get into gifted down payments?
Let's talk about down payments. Talk about, with the qualifying rate so high, how are you finding people are gathering their down? Because that's really what's happening.
Yeah.
And you want to talk about the fact that it's still doable. What I'll say is that there's a lot more living given. Parents are giving.
Now, one of the big challenges, we see this all the time, is that people, if they're renting, regardless, it's hard to save up enough money to kind of get your foot in the door. I remember back in the days, zero down mortgages were a thing, right?
They're gone.
And I've had a few clients recently that have sold those homes that they bought with zero down.
Yeah.
And I mean, the incentives were huge. And there's things like the certain municipalities. I know Peel has an affordable housing program where they Halton. There's a lot of municipalities that have said homeownership is good for our communities, so we're going to lend the down payment and this and that. We won't get into those details here, but predominantly you're 5% down, right? If you're new to Canada, it's obviously a lot more.
Yeah.
There's a benefit of having more than 20% down, where your insurance is no longer in play. But even to get that 5% down, $500,000, $700,000 properties are starter homes now.
Yeah, true.
And so, saving $30,000 or $35,000, what are you seeing out there? Like, what's the reality of down payments for?
Well, I think other than savings, I think a lot more down payments are coming from actually 2 sources. I'd say there's a lot of gifted down payments.
Okay.
I'm
Where do the
finding
gifts come
that,
from?
yeah, I'm finding that a lot of parents are actually giving their children living gifts because with house prices rising since their parents bought homes, they're finding that they're helping their children get into their homes, and so living gifts are being given, as well as RSPs. I've never seen as much RSP usage as I have in the last couple of months. So as a first-time home buyer, you're able to access $25,000 per person.
Per person, so a couple's
$50,000
Right.
for your RSPs. Obviously, you have to have the money in your RSPs.
Yeah.
But if you've got the money in your RSPs, you can access that without penalty. You have 15 years to pay it back. So I'm seeing a lot of that, but definitely those two are really what's making the down payments and what's helping those first-time home buyers get into home ownership.
We even teach a method at the buyer class where we would explain that it doesn't actually have to be your money in the RSPs. You can actually get a bank loan or take that money from mom and dad, put it in, and then take the money out. And then what that creates is a tax refund. So we like to use these acronyms like OPM, which is other people's money.
That's good. I like that.
Or BOMD, Bank of Mom and Dad, right? Is to use those kind of tools and a program like the Home Buyers Plan, the for RSPs. It's the only time in your life when you can take money out of your RSPs tax free. So why not use that?
Yeah, don't miss it.
So you're seeing a lot of gifted down payments, and I remember I'm an only child, and my dad says this all the time. He says, "Well, you're going to get the money anyway."
Well, that's it,
right? So why not use it while I'm still around? And obviously, getting in the door is a big message, and that we talk about frequently on the podcast. Is the sooner you get on the train, the sooner you ride for free.
It's very true.
Yeah, and the sooner you can leverage any appreciation, any mortgage pay down to your second, third, fourth, fifth property.
Yeah,
right?
Getting the down payment is usually the most difficult, but there's a lot of options out there. Yeah.
Great. So that's a little bit about mortgages. And any final thoughts about what somebody maybe would want to look out for in mortgage land, or ways that they can be successful?
Well, I think first of all is make sure that you have the right partners working with you. It's important to have the discussion, to understand everything we've talked about, affordability, and just making sure that you ask the questions. Don't be afraid to ask the questions because, yes, we hear them all the time, but it's the first time you're going to hear the response to it. It's important that you ask them.
And everybody's different too. I mean, as much as we can try and drill down and get granular on these episodes, the advice that we give individually is vastly different.
Very different. And I think that's it. I always tell clients when I meet them, you can ask me anything because I think sometimes they'll wait until the end just to ask you questions because I've had them. Sadly, I didn't have a broker back then to ask those questions to.
Yeah.
But it's important to have. I'm sure you find the same thing.
I find our job a lot of times is to help them with the world that they don't know.
Yes.
Right? Because you'll say, what questions do you have? And they say, well, I don't even know what questions to ask. It's like that whole Henry Ford quote where he says, if I asked people what they wanted, they'd say faster horses. And so his paradigm shift was he introduced people to an option that they didn't even had.
Sure.
Yeah.
I have one final thought that actually just came.
Sure.
It would be credit. Credit is so important. I don't think everybody understands how credit is, how it's so important. It will open up doors. Yes, you need good income, you need all that stuff, but it's keeping your credit, your credit cards up to date, keeping everything up to date. We can talk a lot about that, but really it's just basically talk to somebody about your credit now. If you're planning to buy a house in 6 months, in a year, let's look at it, make sure everything is good, and plan now for tomorrow.
And pay your 407 bills.
Yes.
And pay your cell phone. Those are the two that get
people
they get people in trouble. So there's no point fighting over a $20 thing on your cell phone bill if it's going to inhibit your ability to buy. So thank you, Anna.
Thank you.
If somebody wanted to reach you, how would they communicate with you? Phone,
so you can call me. That's probably the easiest. Either call or an email. And I guess you'll attach it, or do you want me to give you?
Let's talk.
Sure. So my email address is anna@lamortgageteam.com. So it's ANA.
Right.
ANA. And then my number is 905-870-0513. And that's also my cell number. So I do answer, and if I'm in an appointment, I'll get back to you after the appointment. But honestly, if you text me, I'll get back to you right away.
There you go.
Yeah.
It's the secret stash.